See that okay?
Definitely.
Okay, fine. All right. Right. So yeah, so Brendan asked me to come back today. So I was on the event on Monday, and he asked me to come back and just sort of expand on what I was saying on Monday. And what I was saying on Monday was I was really talking about the bigger picture, right? So linking together the stock markets, the property markets, and what's happening on the sort of macro picture, and what has happened and what is likely to happen. So there might be a little bit of overlap with what Daryl's just said, but it's from a slightly different perspective. Daryl's obviously a lender, and I am an
Yeah.
investor, and I represent a network of private investors, and we co-invest into opportunities together, and that's where Invest Like a Pro comes from. So we are sort of co-investing into opportunities. Okay, so I'm just going to take you through a few of these slides here now. So, the first question is why the market rally. So we've had a really sharp stock market rally, so which bottomed on March the 23rd, I believe, from memory. So March the 23rd is when the market bottomed, and we had a huge rally, which was actually a 30-year record in terms of the sharpest and the quickest stock market rally we've seen for 30 years. Okay, and a lot of investors were flabbergasted. They were sort of astonished by, why was that market rallying? Um, all of the news, you switch on your TV and you hear about people dying everywhere, and infection rates, and in fact, the interesting thing is when the market bottomed, that was the same day when Boris Johnson announced the lockdown, and since that day, the market was just on fire, and so people just couldn't add it up. They couldn't work out what was going on. So let me just show you. Okay, so this is a longer term chart this is the Footsie 100 and how it's behaved, and so essentially the market follows what it considers to be the future path, right? It doesn't listen to media headlines. It doesn't listen to what the sort of the media frenzy and the newspapers and the TV headlines are suggesting, right? It always looks ahead. It tries to look 12, 18, 24 months ahead, right? And when the market was crashing up until March the 23rd, we all knew that we were going to be in a big recession this year, right? The markets knew that, we knew that. We didn't know how deep that recession was going to be, but we all knew it was going to be huge. And so what the markets tend to do is they just they collapse and then they ask questions later, because uncertainty is the worst thing for markets. But the point is, they always look forward. They try to look forward. Okay, so here's just I've taken this chart back to 2008, and if you remember the previous recession, the previous financial crisis. So the market peaked in October 2007. Here's just on the top left, you see the red arrow. Market peaked October 2007. And that was well before Northern Rock collapsed. And Northern Rock collapsed, I think, 3 or 4 months after the market peak. And the market started collapsing well before all of these events. So Northern Rock, Lehman in the US collapsed in September 2008. And by the time the UK finally entered recession officially, right, we were almost at the market bottom. So the point I'm trying to make is that the market always seems to know before we do. And not always, okay? It doesn't always get things right, but more often than not, it is correct. It anticipates future events, future economic events. Okay, so it worked on the upside as well. So you see the green arrow here. The UK came out of recession around the end of 2009, but the market had bottomed, as you can see here, in March 2009, so a full 6 months before we actually got the news. And so again, the market wasn't following what the media headlines were saying. At that time, the media was talking about mass unemployment and the banks collapsing all around us and all the rest of it, but the market shrugs that off. So why is this relevant for property, and why is it relevant for the economy? Because it's very relevant, because what's affecting the markets is the same thing that will affect the property markets when we eventually come out of lockdown. It's the same factors, but the equity markets are more liquid, right? So they are trading more in real time. So you see what's going on in real time. The property markets are very illiquid, and we don't get a good sense because there are no transactions, as Daryl mentioned earlier. We won't get a good sense, a true sense for where the market is going in property for maybe another 6-9 months time. Okay, so what I would say is that, give the market some respect because it gets it right more often than not, and people generally have a habit of shrugging off what's happening in the markets because they don't think it's relevant. And secondly, they sometimes say, "Oh yeah, look, this is a dead cat bounce, and it will come down again because we've had that huge rally." It might do, but history shows us that it normally gets things right, as I said. Okay, so why is this different to 2008? So we come back to, before we move on to this, we have to sort of look back at history to see what has happened to the equity markets, what's happened to the property markets. And in 2008, 2009, the equity markets fell 43%, and the UK property market fell by 19%. Okay, so you always see the UK property market fall by less than the equity markets, and that's because the property market isn't a pure investment class. People need property to live in, right? So there's also that utility element. People need property for shelter. They don't need equities for shelter or anything else. It's a pure financial thing. Okay. So we're always going to see UK property, or any property market for that matter, being more defensive than equities. So we look back at 2008, see what happened then. So the market, as I said, fell 19%. This time round, I don't think it's going to be as bad. Okay. Um, my previous expectations were for the property market to fall between 10 to 20% based on what we saw before. And as the days go on, I'm kind of moving more towards the better end of that range. Okay, so I think the property market will probably fall 10%, um, if not less, right, over the next 12 months. So why is that? Why is it going to be better this time around? So there's 3 reasons. I think Daryl touched upon this earlier, and this is a really important thing. So the most important thing for the property market is not Brexit, is not even really coronavirus or things like unemployment. And the most important thing that has historically affected the property markets is the availability of credit, and that in turn depends on how healthy the banks are. Okay, we kind of heard that before, but this is a chart showing how healthy the banks have made to be. So since the financial crisis, the banks have had to clean up their act. They got into a lot of trouble in 07 to 09. And one of the reasons they got into so much trouble is because of this chart here. So what this is showing is how much capital the banks have compared to their assets. Okay, so it's their capital adequacy ratio. It's almost like as a property owner or as a developer, how much equity do you have in your property? It shows the margin of safety, the equity cushion. Okay, and it's a similar concept here. So it's slightly different in terms of how it's worked out. But the banks, as you can see, were at you know relatively low levels of capital. And there is another measure called Tier 1 capital ratio, which was even lower at 5 or 6%. But we've taken this, and by the time 2007 came around, the banks were just lending like there was no tomorrow, right? You may remember Northern Rock, which was offering 110% mortgages. And this was happening all over the world, and especially in the US. So we saw this chart, coming down, which means that there was, reduced level of equity cushion for the banks. And then we had the recession, and you can argue the recession was caused by the fact that the banks were just going crazy lending, and so we had the recession caused by the housing collapse in the US. And then the regulators came down hard on the banks, and they said, look, we don't want this to ever happen again. We need you to clean up your act. We need you to increase your levels of capital, levels of equity. and we need you to have and demonstrate a greater level of cushion, a level of capital adequacy on your balance sheet. And that's what happened. So you see this line just shot up following the financial crisis, and it continued to go up. And so we now, and this only goes up to 2017, but by the time we got to 2019, that was at really decent levels, 17, 18, 19%. And this is in the US, by the way, but it's a similar picture all over the world. The US just has better data on these things. So our starting point for this recession is that banks are in a much healthier position. And that's really good news for property, because property is dependent. Property is a leveraged asset class, right? Most people buy property using leverage, and you need the banks to be healthy for that. So that's the one thing. That's really critical. That's the first thing I would say. Okay. The next thing is the housing market now compared to 2007. And again, we are in a much healthier position now compared to 2007. So there's two charts to demonstrate that. Okay. So the first thing is UK house prices to earnings ratio. Okay, this is a valuation measure you can apply to the housing market. It's not always the most relevant measure, but it's a very good measure. So we have in 2007 that ratio peaked at 6.5% almost. Okay, this is all data from the UK housing market from Nationwide. So we peaked. So that kind of shows that the housing market was overstretched in terms of valuations. And since then, we came down because of the crash, and then sort of went up again when the market went up, and then we've kind of steadily sort of come off from those high levels. Okay, so we're not at a stretched level. In fact, following Brexit and all the political uncertainty, we are, we've had a couple of years of sort of uncertainty. No one's really been over levered. No one's been really sort of excited, exuberant about the housing market. So we're in a much better position compared to 07. And then you look at this is the next chart on the right, is the affordability ratio. Okay, so this is how much first-time buyers are spending on their mortgages as a percentage of their net pay. Okay, so again, this chart has in 07 we were at a peak. Okay, again showing how sort of elevated the housing market was back then, and since then it's been coming down. Right, a lot of this is down to interest rates coming down as well, so that's helped. But overall, housing is a lot more affordable than it was in 07, and so that bodes well for the housing market. So between these two, these are good measures for why the housing market is healthier compared to 07. So again, more evidence to show this is not going to be 2008 again. And the third reason why we're in a better position this time around is because the authorities, both the government and the central banks, have been really quick to jump on this, right? So they've added support. So we've seen what the government has been doing in terms of furlough and grants and all sorts of things, and they did that really quick. I mean, the chancellor came out, very, very quickly and effectively, I think, in terms of limiting the damage, and they were just putting money into this, which they didn't do in 07. And central bank, the Bank of England, came out very, very quickly and announced QE and reduced interest rates down to next to nothing. So the response from the authorities, the policy response, has been really quick, right, and effective. I think it will be. It's going to lend support to asset prices, both stock markets and housing markets. So the next question from that is, a lot of people have said, okay, well, fine. Okay, they're spending a lot of money on this, but what about debt levels, right? Debt levels are going to increase as a result, and that's going to cause its own issues. And yes, for sure, the debt levels are going to increase. There's no doubting that. And, in response to what's happening, which is a pretty severe situation we're in right now. But so, okay, put that debt level into context with what's happened historically. So these charts, the charts on the dotted lines, the dotted bars, are showing what we're going to end up with in probably 2021. What's going to be the impact on the overall government debt to GDP ratio, private debt to GDP ratio, and this orange line shows what the budget deficit is likely to be, okay, next year. So in the grand scheme of things, compared to history, it's actually not that bad, right? So all of these people who are sort of going nuts with their concerns and their media hysteria about how much debt levels are going to go up. Yes, it's going to go up, but compared to the global financial crisis, compared to historical peak levels, it's all going to be manageable. And the thing is that what most people expect, what most economists and most commentators expect, is this is going to be a very deep recession, but it's going to bounce back pretty well next year. Okay, assuming there's not going to be a recurrence of the virus towards the end of this year, early next year, and provided we get a vaccine, hopefully within 12 months as well. If those things happen, then I can't see. We've had viruses before, and the same thing has happened. People get very concerned. We've had terrorism, 9/11. We've had all sorts of things happen, and people at the time always talk about how this is going to change everyone's behavior, and the recession is going to be deep and prolonged, and every time we bounce back. So as long as the virus doesn't bounce back, as long as we get a vaccine early next year, then we start to return to normality next year. Okay, so we're going to get a recession, probably 5 to 10% negative growth this year, and most people expect a partial recovery of 4 to 5% next year. Okay, so then what that will do to debt levels is that will reduce our debt levels. So this is hopefully what will be a temporary increase in debt, and as growth comes back, we'll have a decline in these debt levels. So yeah, that sort of wraps things up in terms of where I see things going from a sort of chart point of view. What's that going to do to the housing market? Yes, we're going to probably see a decline of 5 to 10%. 10% is probably the base case in terms of where the residential housing market goes. Which sectors are going to do well? Sort of plain vanilla sort of family homes will do quite well, I think. Or less bad, I should say, not well, less bad than all the other markets. The areas that will probably be hit are sort of the areas which are kind of hotspots for serviced accommodation, hotels, those kind of things are probably not going to do too well in the short term. Multi-lets, possibly, I'm not sure, it's the jury's out on that, but single family lets, they'll probably do less badly from that. Okay, commercial is probably not going to do so well. So retail and office, if you imagine big offices, they're not going to do too well, because the big offices, like the big banks, they're probably going to downsize both their staff and their office space, right? They're going to probably encourage more people to work from home, and so they'll need less office space. So all of that stuff is, probably not in a good situation. The high street and retail was already in trouble before COVID, and that trend is just going to accelerate as people do more sort of online shopping. So then that leads us on to industrial. Industrial, again, was doing well at the expense of the high street. So warehouses and logistics I'm talking about, and that will probably continue to do even better going forward. And the final thing is manufacturing and sort of heavy industrial stuff. So factories and manufacturing. There is an argument, people are already talking about onshoring back from China, right? So companies who were once sort of offshoring to China and other markets will probably look to do onshoring, and that's going to be supportive for factories and manufacturing. So those are some of the areas to be looking out for, I would say. But my overall sort of takeaway is that, yeah, look, don't pay too much attention to media headlines, because that's always going to tell you the worst possible outcome. Take your outlook from what's happened historically, right? Because history doesn't repeat itself, but it rhymes often, right? So take your cues from what's happened historically, and sort of focus on the cash flowing sort of simple stuff, which I think is going to do well over the next 12 months. And that's it, Brendan. So yeah, can't hear you.
Thank you. So let's go back to the main screen. Let me just.
Sorry, Brendan. I've the final slide. Here's my contact details. So, as I mentioned earlier, invest like a pro. We invest into other people's projects, and if you're an investor looking for sort of secured, de-risked returns, which have got security inbuilt, with good returns of 8 to 10%. Those are the areas that will do really well in this new environment. And if you're interested in learning more, yeah, there are my contact details. You can register on the website.
Thank